QYLD might look like it's a great dividend ETF. It's currently showing that it yields 16%, but I'm gonna explain why that yield is deceiving and why it's actually the worst ETF that most investors could own. All right, so here's the thing. When you own QYLD, you're not actually getting paid dividends for companies. You are getting paid distributions from the fund. The fund actually owns tech companies. That's key. That means there is risk to this investment. It is going to go up and down, at least the cost of the investment, just as much as the NASDAQ 100. Then what it does is it sells covered call options and pays out the distributions, the premiums that it receives from those covered call options as distributions. Because of that, these are not qualified dividends. They're actually unqualified dividends. So therefore, they are taxed at your basic income tax rate. The advantage to dividends is that most of them are taxed at a long-term capital gains tax rate, which generally is about 15%. I'll go into tax rates in just a second. I'm not a financial advisor. Do your own research. Talk to your own tax advisor. This is for my own buying decisions. Let's explain what we're talking about these distributions and how inefficient they are. This is from Wealthfront. QYLD may be tax inefficient as distributions from the fund may be taxed as income, and dividends from underlying stock holdings are not considered qualified dividends because of the offsetting options position. QYLD isn't eligible for tax loss harvesting since we can't find a viable alternative fund. Also has a very high expense ratio, 0.60. And here you go. If you are looking for income and you're looking for growth, this is not for you. $22.58 is the 52-week high and a $15 52-week low. The only reason this dividend has increased, it's not because they're paying more, it's because the price of the fund has actually gone down, which is something you don't want if you're looking for stability. Now let's look at SCHD. It yields much less, around 3%, right? But it's taxed as qualified dividends. So Schwab US Dividend Equity ETF tracks the Dow Jones 100 Dividend Index, meaning it selects only the top 100 financially healthy non-REIT, MLP, or preferred shares that have been paying a dividend for at least 10 years. Thanks to its composition, this ETF pays only qualified dividends. Now, let's get into how the differences in how dividends are taxed. So, qualified dividends, SCHD, or dividends generally that you receive from owning something like Home Depot stock and you get paid dividends. There is 0%, 15%, and 20% tax rate. So if you fall into, if you're married, filing jointly, $83,000 to $517,000, that's going to be a lot of people. Or if you're single, $41,000 to $459,000, you will get taxed at 15%. So if you make $1,000 in dividend income through qualified dividends or the SCHD, you're going to pay $150 in taxes on those dividends. Now, the ordinary tax rate. So basically the same tax rate, right? We'll go to that 83,000 level. If you're single, 41,000 to 89,000, or married filing jointly, 83,000 to 178, you pay 22% taxes on ordinary dividends, meaning the dividends that you would get from QYLD, if this is your category, you would pay 22% on those. So the same $1,000 in dividends would actually, you would pay $220 in taxes versus $150 from SCHD. Now, the higher income you are, that goes up more, all the way up to 32% if you are between single 170,000, 215, or joint 340 and 431. So that's got to be something you talk to your tax advisor about and take into consideration. Taxes aren't even the reason that this is by far the worst fund, right? First of all, the price of the ETF is really never going to go up, and if it does, it's kind of only temporary because they're capping their gains since they're selling covered calls on top of the positions. It's extremely complicated, but the point is, you can look over its entire time frame. The actual price of the investment has not gone up, meaning you're only relying on dividend income from this fund. You are not going to get capital appreciation, which is a very important part of total returns. I'm going to show that in a minute and compare QYLD to SCHD, the QQQ, and even VUG. So over its lifetime, since 2014, shares are actually down 37%, right? Now, let's look at dividends. The dividend history, same thing. Over its entire lifetime, back to 2014, back in 2014, it was paying a monthly dividend of 26 cents. Now, in 9/18/2022, that's actually down as well. It's paid a monthly dividend of 17 cents. So even if you're relying on this thing for income, that's not even reliable, right? Because it goes up and down, and when the market does bad, which could be when you might need money or something like that, the fund goes down and the dividend goes down as well. Now let's look at SCHD, right? So since 2012, back then it paid a monthly or quarterly dividend, of 12 cents. I believe it was quarterly. And now, look at this. The dividend has grown because it actually owns underlying companies who the whole focus is to grow their dividend over time. So all the way from 12 cents to 64 cents a quarter in 2022. That's something like 4x, or it's 400%, 400% dividend growth. But that's not all. Look, now we're looking at total return. So this factors in the dividends paid out plus the growth of the underlying fund, which is something that investors need to consider. Again, we're looking at the QQQ, the VUG, which is a Vanguard Growth Fund, the SCHD, and the QYLD. Top to bottom, QQQ 238% since 2014, VUG 162, SCHD 150, QYLD 59% when you factor in the loss of the actual fund and all of those dividends that you received. So again, don't just look at yields, dive deeper, find something that works for your goals, do your own research, talk to your financial advisor, your tax advisor, whatever. This isn't advice. Just look beyond just the dividend yield rate. The QYL, I will never own QYLD.